Commodity prices are often driven by sentiment, and investor sentiment can shift as new data becomes available. In this episode, we are delighted to welcome back Warren Pies, founder of 314 Research, who closely tracks how investor sentiment is shifting and how that changes the outlook for commodities. Welcome to the Commodity Exchange, a podcast where we bring you insights from the world of commodities. Whether you are an investor or just want to learn more about this topic, this podcast is for you. I'm Mobeen Tahir, Director Macroeconomics and Thematic Research at WisdomTree.
And I'm Nitesh Shah, Head of Commodities and Macroeconomic Research here at WisdomTree.
Before we begin, I do need to state the following. To clarify, the views and opinions expressed in this podcast are those of WisdomTree and in this episode, 314 Research, and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast, research, nor as investment or tax advice. The information and opinions expressed in this podcast are not a recommendation, offer, or solicitation to buy or sell any securities, and reliance upon them is at the sole discretion of the viewer. Please remember, past performance is no indication of future results. So with that out of the way, now, Nitesh, how about I pass it over to you to bring Warren into the discussion and get going?
Thank you, Mobeen. And Warren, welcome back to our podcast. You are one of our first repeat guests, so really glad to have you back and really do value your comments. So that's why we've got you here. But Warren, for those of you, those in the audience who don't remember you, tell us a little bit about 314 and what you do there.
Sure. Yeah, I'm glad to be back, and it's I guess an honor to be one of the repeat guests here, and so hopefully I can live up to it. Yeah, at 314 we are an independent macro quantitative research shop, and so we do everything we do is data driven. I do have a background, and I guess that's why we're having this conversation. I have a fundamental background in commodities, and so I think we do take that fundamental knowledge of commodities and lace it into all of the models that we implement. And we just look at the world from a top-down and data-driven perspective. And so we try our best to stay unbiased and independent. And I honestly believe that the fastest route to an edge in these markets is a behavioral edge. And the best way to get a behavioral edge is through systematic rules and processes. And hopefully some of that comes through today.
Excellent. And so your models give buy-sell indications to various asset classes. Looking at commodities and oil, what is your framework? How do your models work in terms of providing a signal whether to go long, short, or neutral?
Yeah, so every market, when we get down to what we call our core models, so we are just modeling whether we be long, neutral, or short a given asset. And crude is probably the asset we're most well known for. Our model has in real time performed extraordinarily well. It's actually performed better out of sample than it did in sample, and that's we really try hard to build a model that can do that. And so over the last few years, crude's been roughly flat, and I think our model has returned 80-90%, something like that, from falling signals. So we're doing well, and it's really a better trader of oil than I am. And it's something that I've taken all of the things that I find over the years of testing and learning in the space and just crystallize them in this model. And so we have four basic components. We have a positioning, which we're going to talk about more, technicals, physical market, and inventories. Those are our four components in the model. And they kind of operate independently, and we look for the weight of the evidence to be on the side of a given signal. And so in the current backdrop, what we've seen is kind of a persistent, since COVID and since the COVID sloppiness was cleaned up, we've seen a persistent physical market deficit. So you see things like the curve in backwardation, more or less healthy refining margins and differentials and things like that you would be looking for to signal that there is a near-term deficit in the market. So that's just kind of the backbone of the model signal and why we've been generally oscillating between neutral and bullish over these years. And so when you have that kind of a backbone to the model, you then have to layer on some things that are more tactical. And so what's more tactical? Well, the two components in our model that have been just extraordinarily accurate and able to snipe these moves is technicals. So we rely on price action. I have our own proprietary signals there, which I'm happy to talk about them in general terms. And same with positioning. So, the paper market has grown in influence for crude oil. It's many multitudes larger than the physical market at this point in time on a daily basis. And so how the paper market moves, how futures positioning evolves, really pushes price around more than it has in the past. And so being really attuned to the futures market is the most, I'd say, the easiest way to get a sentiment gauge of crude oil. And it's been really if you decompose what's driving our model, it's been sentiment and technicals with the backbone of physical market, bullish physical market. So that's the structure of the model and kind of the things that have been driving over the last few years.
Wow, so there we have it. Sentiment is probably a key thing in the oil space, and that's an impressive outperformance, 80% versus roughly a flat market. But recently, you've noted that your signals have changed, right? So you were looking at it's in terms of being negative on oil prior to last month. You had sell signals. They've switched over to a buy signal. What's or an upgrade away from negative. So what's changed there recently?
Well, it's mainly sentiment. And so it brings out a good point, which I think is that there's always a tension between what you think and then when you're running models, what your models are telling you. And you have to be able to submit yourself and your ego to your models. And so if you ask me, as we came through into that OPEC meeting, and I looked out over the year, if you told me OPEC was going to have this kind of dissension, I thought it was a pretty bearish backdrop. And our model reflected that at the time. And one of the big reasons, I'm not just going off half-cocked and making those projections. I'm looking at the data too. And so I can see, like, at the time we're going into the OPEC meeting, coming off of the geopolitical risk premium blowing out in the beginning of April. And I had said, I think we're going to rally up to 90, and that was going to be about it in the end of Q1. And then from there, the picture got much more cloudy. So we downgraded commodities at that point in April, and I expected a pretty decent route of crude oil, to be honest. And I thought it would be persistent. And the way I mapped that out is that I thought it was going to take us a number of months to build back the short positions necessary to have a good entry point. But what we really saw was OPEC had the plan to reintroduce supply onto the market in their June meeting. And we did have a sell-off as I expected, but in price doesn't set a bottom. Positioning sets bottoms, just as a clear note here. And so what we saw and the term structure. So if you give me two tools to find a bottom, I'll find it by combining our signals on positioning along with term structure. And so as we came through that, we saw short positions in the managed money group, which is hedge funds and CTAs. At this point in time, it's a big discussion topic in the oil market. I'd like to think that our firm has been part of bringing that out into the mainstream. And so that short positioning went up to a level that we hadn't really seen it except a few times post-COVID. And it's really where you see bottoms. Like the downside is off the table once you get short positioning that high. So even though I expected more downside in the market, at that point in time, we came out and upgraded commodities, closed out our underweight positioning, which we had since April, and said, look, this is not where we would not expect a significant more downside here. Now, when you transfer that over to our model process, it's very disciplined. And so it looks for a reversal of those positions. So you want to see an extreme and then a reversal. And that's what we just triggered a few days after we made our discretionary call to get out of the underweight commodity position our model registered a reversal of these positioning of these managed money futures positions, and so it entered a buy signal. So I was negative coming into the OPEC stuff. My personal view is wrong, and I'm totally fine with being wrong on stuff like this. It's about having a process, and so I think this is a trade that should persist through the summer, really. And I don't see it as a roaring rally. I'm going to follow my indicators, but I don't see this as a massive rally. We haven't quite yet gotten our technical confirmation. That's the next piece of the puzzle. I think that will come, actually. If I look at what's happened, we look at indicators that are more between the 21 and 35 day frequency for crude oil, which is pretty different from like equity markets, for instance, where we look at like 150 to 200 days for trending markets. And so anyways, that's the next piece of this puzzle, but our model is on a buy. It would just be further confirmation. The stats that I give to our clients is that when we get, and we had this at the very beginning of the year, when we get our technical and positioning component on a buy at the same time, it's not a guarantee that oil is going up, but it is the strongest signal that I've found as far as a batting average. So 70% of the time, historically, when those signals are bullish together, crude oil is higher. And those two signals are bullish at the same time, only 22% of oil's history. So it's pretty rare, and it's not a guarantee, but it's, when you look at a market, if you can get something where your odds are 70% in your favor, you got to keep playing. Every time you get that opportunity, you've got to play those odds. And so that's where we're at. I expect the technicals to flip here soon. And so that's what we're looking at. And to me, I see that as a summer kind of rally.
Warren, I'd like to put your rating upgrade in the context of what we're seeing in commodity markets, in the sense that it seems like sentiment is shifting quite quickly. A couple of months ago, investors were very optimistic about certain asset classes. We saw certainly industrial metals rallying, and then in the last month or so, we've seen a reversal there. I'm curious to know, in the context of how you've rated commodities historically, how frequently do you see such a rating change as we have seen an upgrade recently? And what would constitute a scenario where it might change again? So just putting it into context, is it an ongoing endeavor that you keep tracking, and anything could trigger the change again? Or is it relatively rare for an upgrade like this to happen?
It's not, I wouldn't say it's rare. It's opportunistic is how I would look at it from our perspective. These signals, though, that when we isolate just the positioning in the futures market, what I'm seeing is the signals are compressing and becoming a little less powerful than they were in recent history. And I think that, to be totally honest, and I wish that everything's just stayed the same and we could always, outperform the way we have the last few years. The truth is, you're going to have to constantly do R&D and test your signals and understand if they're deteriorating. And what I know is that there are more people looking at futures and trying to fade them like we've been doing for years. And you have OPEC in particular, who I know from contacts that the Saudis and other participants within OPEC, and you can listen to their discussions. They are targeting shorts. So what that does is, when you have everyone, it's kind of a reflexivity type of argument. Once everybody is looking at the same thing, the signal changes. It's not going to have the same effect. So I expect us to do more R&D on this stuff as we go forward. One of the things we do that we don't talk about much, we don't share the deep research we've done, is how we combine these positioning data with term structure. I think you're going to need to mix and match these indicators. I saw a lot of people who are kind of jumping on the positioning bandwagon in this rally. And just when markets are kind of they torture the maximum amount of participants in a certain way, where once everyone starts looking at an indicator, it starts losing its usefulness. So I'm well aware of that possibility, and I'm hoping that we'll stay in front of all that with our process. But for now, we're sticking to what's worked, and it seems to be working again this cycle.
Yeah, it's a great point you've made. That that Saudi Arabia has been keen to punish the shorts. So that hopefully consolidates the fact that when shorts are getting too long, or there's too much length in the shorts, that there's time for a pullback, because there could be a policy related reaction to that. I guess OPEC's narrative after its meeting, that it's not pre-committed to tapering off those um, the supply restraint, and it'll use data and market conditions to guide it. Possibly also helped it, but in terms of the U-turn in the prices as well. So that's hopefully all worked well in your sort of in your framework. But another area where I can see you're bullish in the commodity space is gold. Now, gold is quite a different commodity to oil. It must have lots of different aspects that you must look at in terms of looking at buy and sell signals there. Can you tell us a little bit about your framework for gold?
Yeah, absolutely. The one thing I'd say, just to tie up the point you made about the Saudis and oil, is that they made that determination that the oil may or may not come back online. And I think that was a little bit of job owning ultimately. But what they really did was, and this is a point I make all the time with oil, is what they really did was, if you check out Saudi exports following that OPEC announcement, they really came off. And so what I think they did is they tightened a little bit the physical market to just kind of squeeze those shorts out and give us a little push. And so that's stuff to keep in mind. And the big principle at work here is that oil is such a short duration asset. If there's a tightening in the physical market here and now, it doesn't matter if there's a bearish catalyst coming in 6 months. The market doesn't have the ability to look all the way through that and discount it. It's a very short-term focused market. So that's I'd say that's the setup also as we go through the rest of the year with oil and how we're going to navigate it. Gold is, like you said, a totally different beast. Gold is a monetary commodity and monetary asset. And the thing is, I'd say, I've said this many times, is that we have a gold model and it's working well too. It hasn't been performing as well as our oil model, but it's doing very well and it's catching this move right now. I've said modeling gold is like trying to nail a jellyfish to the wall, though. It's a really hard thing to do. It's if you go back and study history, what works in gold across each cycle is just different, and you need to make room for that in your analysis. So it's a tricky thing to model, and you have to be able to almost get the regime right to understand what to be watching. And ultimately, the thing that comes to that bubbles to the top with gold, to me, is price, because price is ultimately going to rule everything. And you need to understand that gold moves in certain, I wouldn't say they're predictable, but they're consistent patterns over history. And one of the big patterns, whether you're looking at the near term or zooming out and looking at a secular picture, is gold will go into these basing range trading for many periods. You could be on years or days or weeks or months. It'll go into a base and then have an explosive breakout outside of that. And it can go against all kinds of your preconceived ideas at that point on what works. You just don't want to be underweight or out of that or short that market when it breaks out. And I think that's what we saw here. Gold went through this period post-COVID where we tested this range over and over and over. And the breakout this year came in the face of higher real rates, which a lot of people said can't happen, in the face of GLD outflows. Yes, there was central bank buying, but central bank buying had been going on for years post-Russia, Ukraine. I think that we just hit a tipping point. And I still go back. I believe it's a hard thing to model, but you have to keep it in your mind. Gold is reflecting the trust or lack thereof in monetary and fiscal institutions. And so what I see going on right now is institutional trust is in secular decline. And this is you see it in the pro-cyclical deficits we're running. You see it, you see it in policy across the board. And I think gold is, this breakout is for real. And so this is, I think, another secular move for gold. We came into the year saying we thought we'd see 2,500 an ounce on it. I still think that that's in the cards. It's not that far away at this point. But it's the lesson of history is that gold can keep running in this environment, especially if, let's say, we have none of us have any idea what the election is going to look like in the United States. But on the other side of that, if there isn't a move to narrow the deficit or something like that, I think gold's still a great addition to a portfolio.
Warren, I like what you said about getting the regime right. And one regime that many investors want to get right is, of course, the monetary policy regime and the potential switch to a more accommodative monetary policy from the Federal Reserve, and when might that happen? I know you have views on the macro backdrop. Curious to get your take on what your expectations are from the Fed for the second half of the year.
Well, I honestly believe that this last CPI report and labor and jobs report were both really important, and they both, in my view, they probably cement a September cut from the Fed. And so I wasn't necessarily sure that was going to happen, but one of the things we've been talking about is that number one, we think shelter inflation is going to be sticky. So you're going to need a real cold set of inflation prints for the last half of this year in order for the Fed to hit their targets that they lay out in their SEP. We've been skeptical of that, but this last CPI report, and then you combine it with the PPI report, you can see what PCE is going to be here at the end of the month. And the read-through is quite disinflationary. It's ice cold outside of shelter. And to me, that really gives the Fed leeway. And so I think that that's one side of the coin. The other side is the labor market. So you go to the labor market, and what we've really seized onto in the labor market is the divergence. And this has been going on for a while, but I think it matters now. The divergence between household and establishment survey analytics. And so the unemployment rate is rising. That comes from the household survey. And that's really what the Fed's modeling in their SEP. And it seems to be, it's really a reflection of what they want. They want to cut rates. So they're going to look more at the household survey. And so unemployment rate is up. The SOM rule, which I think is not that impressive of a analysis framework, but the Fed seems to think so, and it's all that matters. JOLT, which I also don't think is all that great of a data series, but the Fed looks at it. So I don't, my ego, what I think doesn't matter. It's what the Fed thinks matters. The Fed looks at JOLT's report. They see what's going on with the beverage curve. They see what's going on with the SOM rule and the unemployment rate, and that's what they're going to focus on. So SOM rule will trigger, that's a 0.5% or 50 basis point rise in the unemployment rate on a 3-month moving average basis in the last 12 months from the low. And what we've done, though, is you look over at the establishment survey, and we're still adding close to 250,000 jobs a month for the last year. And so there's a major divergence like we've never really seen before. We've seen divergences, but at turning points like this, we haven't seen them. And so I'm not sure that the labor market is as loose as the household survey suggests. I do see evidence of loosening, but I think the reality is somewhere more in between and probably closer to the establishment survey, in my view. And so that's the setup, but the Fed's going to choose the data that helps support their case. I think we got that cold CPI report. And this is why the market's rallied. I think that really locked in September. And then you come in with the jobs report where you see unemployment at 4% now, despite the 270,000 new jobs. The unemployment rate is what the Fed's going to look at. And so I think we get a September cut. I think that's a big part of why the market's rallying right now.
Excellent. Well, thank you so much, Warren, for all your insights. I think we've learned a lot about how oil trades, how gold trades, and it's really nice to see that the signals are pointing in the right direction to keep them as upgrades in your model. Thanks once again for being a guest on our show for a second time, and hope to have you on again.
Thank you for having me. It was nice talking.
He's very bullish on gold. Now, of course, gold continues to maintain its strength despite rate cuts by the Fed having been pushed out this year. One important consideration when it comes to gold in recent times has been what central banks have been doing, not necessarily in terms of their monetary policy, but in terms of their physical purchases of the metal. Uh, Now, we know that many central banks have been purchasing and purchasing in large amounts. So tell us what central banks are doing, what's motivating them to purchase large quantities of gold, and how that's affecting the discussion on gold prices.
Yeah, so central banks have been extremely active in the last 2 years in buying gold. And 2022 really was the game changer. When the Russia Ukraine war broke out, um, G7 currency central banks kind of weaponized their currencies in the sense that they froze the assets of Russia in their currencies, and that has acted to spook out a lot of other central banks. And one of the primary reasons I believe that other central banks are buying gold in such large volumes is that they're trying to diversify their currencies away from G7 currencies, the dollar, yen, euro, sterling, for example. Um, Now, the World Gold Council do a great survey every year of central banks and look at their intentions for purchasing gold and their expectations for the central banks in buying gold. And they released their report just this week, actually, which makes for interesting reading. Um, Obviously, a lot of the central banks don't admit to the fact that they are buying gold as a diversifier against these other currencies to de-dollarize um, or move away from the G7 currencies. Only about sort of 13 to 16% sort of really put their primary reason for allocating to gold on that basis. Most of them tend to talk about the general traits for gold in terms of being an inflation hedge, being a hedge against adverse outcomes in terms of financial markets or economic conditions. But obviously, the fact that that bucket exists and is slightly growing in terms of answers means that more and more central banks are actually willing to admit to it. But I think it is one of the primary reasons why central banks are allocating to gold in this environment. Now, we did see huge strength in gold purchase in 2022. 2023 only came off a fraction from that 2022 high, all-time high. And then in the first quarter of this year, we once again saw really large volumes, the highest volumes for Q1 buying ever. And then come April, May, we saw a little bit of cooling down in purchases. And even the People's Bank of China, which had made 18 consecutive months of gold purchases, so since they restarted reporting their purchases, they actually went flat in terms of new purchases in May. Um, that had led some people in the market to worry, and that's maybe why we've seen gold prices come off a little bit in the last month or so. But the survey of those central banks provides that reassurance once again that central banks haven't put on the brakes really, and I think they are just making a little bit of a pause while gold prices are this high. Nobody, I mean, consumers, whether you talk about industry or jewelry consumers, yes, they're going to be price sensitive to gold, and we've already seen some of their purchases cool down. But central banks are not completely insensitive to price, so we expect them to cool down a little bit and also accelerate dips. And we have had a dip in the last month or so, so I'm guessing that they're going to start re-engaging their purchases very soon.
So, turning our attention to energy next, and we'll talk a little bit about oil. But before we go and speak about oil, Nitesh, I want to take a step back and talk about climate change in general. And we know that climate change has a direct impact on the material world. We know that it can impact the demand and supply of different commodities. How are you seeing the impact of climate change play out in the commodity world, and which commodity markets have you seen move as a result lately?
Yeah. Um, So this week we actually got some great data out from the energy information statistics. They basically provide the data that BP used to. They used sort of like a very much an industry focal point for when they're released, and it's clear here that world energy demand is on the rise, um, and um, while renewable sources of energy production are also increasing, it's not able to keep up with the increase in overall demand for energy. So, what's clear is that the energy transition that we will talk about really hasn't happened yet, because all we're doing is just providing supplemental sources of new energy to keep up with regular demand. If you look into the micro, beyond the headline, yes, there is a transition. Certain countries are transitioning to renewable sources of energy, while other countries are consuming more of the traditional source of energy. And that's a logical pattern to happen. I mean, there are many countries around the world that just don't have enough basic um, energy supply, and one of the only ways to develop and grow your economy is to have energy sources, and they're very likely to go to the cheapest source of energy. But to be able to realize a net zero climate path, um, it's clear that the whole world has to be able to embrace a transition and move towards renewable sources of energy. And what's encouraging is that the cost of technological deployment is falling, and that's helping the adoption of these technologies. But we've got a long way to go. So the clear thing is that anything that feeds into the energy transition is going to be in higher demand, as more and more countries embrace the technologies. But it's definitely the long game. It's not something that's going to be achieved in a short space of time. And in that regard, I think every source of energy um, is being utilized at the moment, and I don't see energy prices having a structural downturn in terms of prices in the short term.
So, if we zoom into one of those sources of energy and talk about oil, we heard Warren Pies talk about oil, and you've been writing regularly on the policies of the OPEC Plus group this year. We know that geopolitics remains an ongoing factor. How do you see the oil landscape evolving? Warren was quite bullish. Do you share his views?
Yeah, I largely agree with what Warren was discussing. Um, you know, it's very important to look at sentiment factors, and we saw that um, the shorts became extremely stretched in oil markets, and that's a reason for a reversal. But one of the other things I would say is that in Warren's framework, where you can go long, short. You can obviously use um, bear market periods to your advantage, obviously, and go remove yourself from the oil market in times of bearish signals coming from a model framework. Um, but equally, when it comes to oil, have maintaining a ongoing position in a rolling futures strategy in oil also makes sense if OPEC is capable of keeping the oil futures curve in a state of backwardation, and that's what they've been doing for the last few years. So they've been keeping the front end of the oil futures curve higher than the places after several months after the near term delivery. And why that's important is because if the curve remains in that backwardation state, if you're invested in somewhere in the curve, say a month out, as that position approaches spot, it will gain in price just because of the curve structure design. That is adding a positive roll yield to an investment. And currently, an investor in a rolling future strategy is getting close to 8% roll yield on an annualized basis. So if nothing happens, the spot doesn't change at all, and the curve just remains exactly where it is right now, you get basically close to 8% roll yield, which is an attractive thing to achieve in the oil markets. Um, I fully agree with Warren that the oil market is very much fixated on the near term. Even though OPEC's decisions may affect oil supply demand balances in several months' time, what's moving is at the very short end of the curve. So we can take news flow as being something important for the spot price or very near term prices, but as long as curve structure remains in backwardation, there is that opportunity for harvesting positive roll yield. But we've talked a lot about gold and energy, and how about we switch the narrative up a little bit now, and let's look at the metal markets. Now, last month when we recorded this podcast, metals were zooming; they were having a great time. Unfortunately, they've given back a lot of the gains. What's happening there, Mobeen? To walk us through what's happening.
So, Nitesh, yeah, like you said, last month when we talked on this podcast, we were talking about an improvement in sentiment, and we were talking about copper reaching for new highs. Uh, and like you said, in the past month or so, things appear to have turned again, and metal prices have pulled back. But it's interesting that if you look at the fundamental picture behind all of this, nothing seems to have changed significantly through this period where prices were first going up and then prices are now pulling back. I think the long term trends that we often mention on this podcast about what are the sorts of things that will create demand for industrial metals in the long term, those drivers still remain in place. And last month on the last episode, we said that perhaps markets were beginning to appreciate that there is going to be long term tightness. There is going to be structural undersupply of industrial metals, given how much demand there is going to be from the applications in the energy transition. So, as a result, we were observing that sentiment towards industrial metals had really picked up, and we were drawing the conclusion that maybe markets are finally beginning to recognize that there is going to be a structural undersupply of these things in the long run. Uh, if we see what has happened in the last month or so, it appears that maybe markets are still uh, being driven by more short term and more cyclical forces. And as a result of those shorter term cyclical drivers, we're seeing sentiment go up and then sentiment come down. So, if we see in the last month what could have triggered sentiment to pull back, well, one thing we saw was that in China, the official purchasing managers index number for the manufacturing sector, and we look at the manufacturing PMI, the purchasing managers index number, as a gauge to see how the month on month economic activity in the manufacturing sector is progressing. And of course, if it shows contraction, then that's a bad signal for industrial metals. If it shows expansion, that's a good signal. And last month, the official Chinese number signaled contraction. And it's interesting, the official number signaled contraction, even though the Kaishin PMI number not only signaled expansion, it signaled a higher number for the expansion than the month before. So there is some contradiction there, but even if markets were entirely looking at the official number, it's one data point, but maybe that possibly has triggered a pullback in sentiment. The other thing you could argue is that, of course, what we saw uh, uh, what we saw in terms of the things we observed last month, maybe it was too much too soon. Perhaps markets got a bit carried away and sentiment picked up too quickly. Uh, and the sort of rally we saw, for example, in copper prices, it's always hard to sustain such a sharp rally in any asset class. And maybe that's why we've seen a slight correction, but we are still on the right track because year to date metals have still shown appreciation. Yes, there's been a pullback, but maybe that pullback allows metals to have a more a more sustainable appreciation as that narrative unfolds. That look, industrial metals are very important things that we need more of, and perhaps we might not have enough of in the future. So um, still that story unfolds, but I guess it's a perfect example of how sentiment, and that's what we said at the start, that sentiment can shift quickly in any asset class. We didn't necessarily see this happening in industrial metals for quite some time before last couple of months or so. We saw that sentiment was fairly subdued. Then uh, it picked up, pushing prices up, and then it's turned again, pulling prices back down. So we could see more of this, but it still hasn't changed our structural, constructive, bullish view on industrial metals. If anything, a pullback in prices perhaps has made some investors interested, uh, seeing it as a potential entry point once again. So we talked all about that. We talked about gold, oil, Warren Pye's model, and of course, industrial metals. We'll close the discussion there. We thank everyone for tuning in. We hope everyone enjoyed this episode of the Commodity Exchange. If you want to hear more from us, please do subscribe on whichever platform you're using. And please take a moment to leave a 5-star rating. You can follow us on LinkedIn or Twitter or X at Nitesh WT and at Mobeen WT. And if you want to learn more about commodities, please visit Wisdom Tree's website, where we have a wide range of research materials and insights. With that, see you all next time.